Hello everyone. In today's lecture, we are going to learn about realized and expected return. So first of all, we are going to talk about expected return and then we will talk about realized return. Now, what do you mean by word expected? Expected means your expectation, your assumptions, and assumptions is related to your future. So something which we believe or assume that this thing will happen in the future, but we are not 100% sure about it. We name it as your expected. That means we are not sure that whether this will happen or not, but we are just assuming it. If this thing happens, this will be the result. If this thing does not happen, this will not be the result. Let's take an example. Suppose I want to purchase this dress. So I am expecting the cost or price tag of this dress. Let's say I assume that the price tag of this dress will be rupees 2000. But there will be various conditions or various factors on which the price tag of this dress depends. Maybe the cost of the cloth, maybe the labor charges, or maybe the design or maybe the brand. Because if you will go to the market and you will observe that different brands have different price tag. Or quality of the cloth also depends on the price tag. So these are the various factors on which I expect that the cost of this dress will be 2000. Similarly, if I talk about the stock price, I have invested the money in stock market and now I have to predict the price. Prediction means future. I am thinking about the future. My assumption is related to the future. So as we have discussed in previous lectures also, there are various factors on which your stock price depends. We have learned about some fundamental factors. So fundamental factors are those factors which are prevailing in your economy, which are prevailing in the industry and which are prevailing in a company. We also name it as EIC. So that means all those factors which are in an economy, maybe your GDP, maybe your COVID, maybe your inflation, maybe your demonetization, maybe your budget. So all these factors are economic factors which affect the stock price. Competition is there. Industry factors are there which is affecting your stock price. Companies paying dividend or not, companies earning more or not. So these are the company's factor, individual factors which are affecting the stock price. So that means the price of the stock depends on these factors. Let's take an example. So what we are going to take an example over here is that we are saying that future is uncertain and our future, that means our expectation depends on certain conditions. Let's say the GDP increases. There is a growth in GDP. Obviously, when there is a growth in GDP, that means all the individuals are earning more. So demand for the goods and services will increase. And if demand for goods and services is increasing, companies are earning more profit. And if companies are earning more profit, investors will expect a higher demand. So that means everything depends on the GDP growth. If GDP growth is good, investors will expect higher returns. If GDP growth is less, investors will expect the less return. Let's take another example. Inflation is there and inflation is increasing. If inflation is increasing, the purchasing power parity of the individuals will decrease. And if such thing happens, the input cost will increase. That means the cost of raw material, cost of labor will increase. And if all these things happen, the company's profit will decrease. And if the company profit is decreasing, investors will expect the lower returns. So I can say that each economic scenario, I have just taken the two economic scenario, and each economic scenario carries the probability that if GDP increases, investors' demand will increase. If GDP decreases, investors' demand for higher return will decrease. So everything depends on the condition. every economic factors, maybe your industry factors, maybe your company factors, everything carries a probability. Let's take one more example. Let's say our expectation is that tomorrow the rain will happen. That means tomorrow is a rainy day. So we are expecting the rain. But we are not sure that whether rain will happen or not, whether there will be heavy rain or not, whether there will be no rain or not. So we are just expecting that there will be a 60% chances of having heavy rain, 20% chances of light rain, and 20% chances for no rain. Now the condition is, if heavy rain is there, waterlogging and traffic jams are there. If light rain, roads will be wet but it is still manageable. And if no rain, no waterlogging. So that means these things, waterlogging will be there or not, depends on the rain. And rain is a chance. We are expecting that this much rain will happen. Okay, let's talk about again economic growth. So what we have done, since we have just seen in the previous example that if the GDP increases or decreases, the expectation for return depends. So we are saying that there is a 60% chance that there is a strong growth in economic growth. 20% chance that there will be a moderate economic growth and 20% chance of a recession. If strong growth is there, 15% return, company will earn 15% return. If moderate growth is there, company will give 10% return. And if recession is there, company is going to give minus 5% return, or you can say loss of 5% will be there. Okay, let's take the scenario, or you can say the assumptions one by one. So expected return is what an investor anticipates or forecasts earnings from an investment in future. That means if these are the condition, what is your expected returns in future? So all the possible returns depends on probabilities. And when we are expecting for the future, it is forward-looking concept. That means you have not invested, but still you are expecting that this will be the return in the future. So it is a forward-looking concept. So what we have to do, your expected return will be the summation. Summation means sum of all the situations, and for what we have to do the sum, probabilities multiplied by returns. So probabilities of each outcome multiplied by possible returns of that outcome. Let's take a scenario. If the market is good, 15% return is there, but the probability is that there is only 50% chance that the market will be good. There is 30% chance that the normal market will be there, and if this happens that normal market is there, you are going to earn 15% of return, 10% of return. And if the bad market is there, so the probability for having a bad market is just at 20%. In that situation, the company will give us the 5% loss, so we will be having a 5% loss in returns. So what we have to do, how we are going to calculate, we are just going to multiply these individual probabilities with individual returns, and then we are going to add it. So we will get the expected return to be 9.5% if this scenario is there in a market. So expected return means summation of probabilities and your expected return for that particular scene or that particular condition. Now let's come to realized return. Realized means real. That means it is actually happening. So realized return is an actual return you earned from the investment after holding it. Holding period means you have just purchased the shares and you will sell it. Maybe you have purchased in the morning, you are selling in the evening. So your holding period is a day. You are holding for 2 days, you are holding for 1 month, you are holding for 1 year, you are holding for 5 years. So that means you are holding that particular stock for certain period of time. So whenever you are holding, it means you have purchased that stock in the past and you are selling in today's date. So it is backward looking. It is a backward looking measure. So realized return depends on two factors. Whenever you are investing in a stock, you get two kinds of return. One is your capital gain. I have purchased it for 100 rupees and I am selling for 110. So I am having a capital gain of 10 rupees. Or if I have purchased for 100 rupees and I am selling for 90 rupees, I am having a capital loss of 10 rupees. So first thing depends on your capital gain or whether you are having a capital gain or capital loss. And second is whenever you are purchasing the shares, company will pay you the dividend. So whatever dividend you have received, that will be another kind of return. So your realized return depends on two things, capital gain or capital loss and your dividend received. So the formula for calculating the realized return will be, you will first of all calculate whether there is a capital gain or capital loss, and then you will add the dividend and divide it by the investment. For example, if I say that you have sell the shares for 110 and you purchase it for 100. So your earning is only 10 rupees. But you earn 10 rupees by how much amount investing? 100 rupees. So 100 rupees you have invested in the past. So whatever your total earnings will be there, you have to divide it by the amount you purchase that particular share. So P1 will be your selling price, that is at the end of particular year, or end of 2 years, end of 3 years. P0 is your purchase price and D means your dividend income you received during that particular year. So let's say you purchased a share for 100 rupees and you sell after 1 year for 112 and you receive 3 rupees as a dividend. So in this case, your P1, that is your selling price is 112. You purchased it for rupees 100 and your dividend income is rupees 3. Now if you will see over here, your capital gain is 12 rupees and your dividend income is 3 rupees. So that means total of 15 rupees you have earned by investing how much amount? 100 rupees. So how we are going to do it? 112 minus 100 plus 3 upon 100. So that will gives you the 15% return. Hope you have understood the concept of expected and realized return. Thank you.